Hello everyone, I am Dr. Goel and this is the final demo lecture. Today we will be covering the third chapter, only the initial few parts of it. The rest of this chapter will be available once you sign up for the full batch. And let's get started without any delays. So this is the corporate governance chapter. This chapter basically tells you about how the various levels in the organization should be structured in. You cannot have, you know, certain things in the way the organization is structured. For example, one person cannot have a lot of power. So to prevent that, there are guidances and restrictions based on certain codes and regulations, which following, if you follow them, it will help you to maintain a clean layout of your company, and that will give the shareholders and other stakeholders the confidence to stay invested and have other relations with your company. So we will be looking at it as we go. So this chapter further develops the principles of corporate governance covered in BT at the knowledge level. So you may not have done BT because of exemptions or any other reason, but if you have done, you could recollect a few things from your past studies. Then objectives and importance of corporate governance. So if someone asks you what is corporate governance, the simple definition is this line: corporate governance is the means by which a company is operated and controlled. Two keywords being operated and controlled. So, how is it being operated and how is it being controlled? So, that involves people having the right level of, authority, responsibility, who is in charge of making the decisions, how they have decided who is in charge of making these decisions, and a lot more things. So, the aim of corporate governance is to ensure that companies are run well in the interests of their shareholders, employees, and other key stakeholders, such as the wider community. So, even when we looked previously that the interests of the company should be for the stakeholders and the wider community, and not the management who is running it for themselves. They have the stewardship, and they are also responsible for acting in the best interests of the shareholders. So the main aim is to prevent company directors from abusing their power, which may adversely affect these stakeholder groups. So as we know that the directors are in a position to, make decisions which could favor themselves instead of the company and the shareholders. They could provide themselves with large salaries, bonuses, and they could do this at the expense of not paying dividends to shareholders, or reinvesting the money back into the business. So they would withdraw a large sum of money for themselves, and then the company is left with nothing to reinvest or to pay their shareholders. So that's really detrimental for the company itself, and it will not help the company grow. And that's not what the investors want. They want the company to grow, and that's how they'll make their money. If directors keep withdrawing it out, then there's no sense for the investors to invest in it. And sometimes there are layoffs as well when people are being fired, and at the same time, they could do this by firing a lot of people and pocketing their pay for themselves. So that's not also, a right and fair way of structuring your company. Then there have been major scandals with respect to this similar thing. Example, Enron, the biggest one example that I can think of. And it's a case study everywhere when it comes to corporate governance. So after this case, there were serious implications and changes which were brought in the corporate governance field. And Since then, the companies, make a conscious attempt to follow these rules so that their corporate governance is in line and there are no such things happening again. Then in the US, we have the Sarbanes-Oxley Act, which is known as SOX, and these introduced a rigorous set of corporate governance laws. So, if you're not aware, US follows a more rules-based approach where when a certain thing is mentioned in the rules, you need to follow and adhere to those rules. You cannot stray away from them, and you have to just stick to the letter. You cannot, use your own judgment that much and work around the rules. If something is said, you have to follow it. But whereas when it comes to UK corporate governance course, it gives a set of best practice corporate governance guidelines and initiatives, which basically means that they set out the best initiatives and best practice principles that you can adopt and work around them. You can use them as your foundation for structuring your corporate governance, but you are not obliged to follow them to the letter. You can do things as per your flexibility and as per your requirements. So that is one benefit here. So this is something you can always, keep in mind that US follows a more rules-based approach, whereas the UK follows a principles-based approach. Then we have advantages of a company following good governance principles. So of course there will be a few advantages when the companies follow a good corporate governance practice. So this will lead to greater transparency, accountability, efficiency, better able to respond to risks, less likely to be mismanaged. So what do these mean? So when it means transparency, so corporate governance ensures that no individual has a lot of power. So everything will be segregated and every person will have different tasks and different responsibilities. There will be more regulations to report stuff to authorities, to the wider public. So there is more transparency. Companies, show and rep, publish a lot of more information than they used to. So there is a lot more transparency. We have greater accountability as everything is set out at the start only that you are responsible and accountable for this. There is accountability. So in case something happens, we always have the person to go to that, yes, it is because of you that such thing has happened. You are accountable for it and appropriate actions can then be taken. Otherwise, we also have the efficiency of operations. Efficiency increases once, there is a set flow of procedures that needs to be followed. After that, we have better able to respond to risks. So when a risk arises, you are in a better position to handle it and mitigate the downside of it because there is a certain set of principles you can follow and avoid something huge from happening. Then if the company is managed properly with regards to corporate governance, it can it is very less likely that it will be mismanaged. So with corporate governance, it basically means how your level of management and board of management is structured. So to ensure that no one person has a lot of power. So we'll look at these couple of cases here. You can give it a read, but I'll, give you a gist of it. In 2018, so this is quite recent, the construction company Carillion was placed into liquidation after building up debts of $1.5 billion. So they took on too many projects and failed to realistically price the contracts, resulting in huge cost overruns and losses being made. In December 2017, the major banks refused to lend more money to Carillion and the company went into liquidation. Employees lost their jobs, investors had to face losses. The government contracts that were in progress would not be completed, and suppliers could also not be paid. So one of the key issues highlighted was that of executive pay. They were earning significant amounts of money despite running the company into the ground. So this basically means that the directors and executives were paying themselves so much that there was nothing left for the company to survive, and ultimately the company had to be shut down. In 2016 itself, the chief executive director earned more than 2 million pounds. This was due to a lack of effective governance. Directors' remuneration allowed them to benefit despite the collapse of the company, as there were no clawback conditions. So there were no conditions. He was just simply being paid $2 million. So this was basically it, that the directors paid themselves so much that there was nothing left for the company, which they were responsible to manage in the first place. So it's might sound basic, but it leads to huge losses on a wider and company level scale. So this is something that you need to think about. It should not happen in this modern day and age. Then we have the world famous Enron. It was a US based energy company, employed more than 20,000 people, and reported revenues of more than $100 billion. In late 2001, they filed for bankruptcy. After a lengthy investigation, it was revealed that Enron's FS was sustained substantially by systematic and creatively planned accounting fraud. So, what Enron really did, so when the Enron bubble burst, before that the shares were at more than $90 each. But after that, they were left of even less than a dollar. So you can see how drastically something can fall simply because of poor corporate governance and anything like that. The entire capital can be wiped out. Investors will lose a lot of money. Number of directors and prosecutors jailed them. We have the auditors, Arthur Anderson. They were accused of obstruction of justice, forced to stop auditing public companies. This ruling against Arthur and Anderson was overturned at a later date, but the damage was done and the firm ceased trading soon after. So, even because of Enron, Arthur Anderson, their auditors suffered huge losses and eventually they had to shut down. Why? Because the entity they were auditing was not complying with the corporate governance principles, and Arthur Anderson, as an auditor, failed to, point it out and notify the investors and the appropriate authorities. So this was a major failing at that time. So this was a high profile fraud that occurred. It is an example of abuse of trust placed in management. So there are two methods, direct extraction and manipulation. So the direct extraction one we looked above, where the directors paid themselves huge amounts of money before, reinvesting or paying it out to the shareholders. The second one we have is the manipulation of share price. So how do you manipulate the share price? If you just basically show $100 billion revenue when you've basically only made, let's say, 10 billion, so that will improve the share price, right? If people assume it to be correct, then they will take 100 billion as the base for their decisions, and that will influence their decision to buy and invest in the company. So if you simply manipulate your financial statements to something, very artificial, it can influence the share price, and that is what Enron really did. And let's say the directors, also have these shares because of part of their performance related pay. So it is to keep their interests aligned with the shareholders as they themselves become the shareholders. So they would want an increase in the share price. So instead of focusing on getting good results, actually, working hard and implementing good strategies, they just manipulate the financial statements to make it look like they took good decisions and the company's net worth increased. But that's not really the case. It's the same where it was. It is the same where it is. But instead, just the financials have been manipulated and made them look like the company has grown significantly. And yeah, that's another major failing of corporate governance if that has been possible by the directors. So then again, it sounds basic, but at the same time, that's how managements have defrauded companies and investors. And, sometimes they've even gotten away with it because of poor corporate governance procedures and regulations in place. But that is being changed now, and it has become a lot more strict. So, in response, regulators sought to change the rules surrounding the governance of companies, particularly public-owned ones. In the SOX of US, there is a set of rigorous corporate governance laws, basically strict laws, and at the same time, the combined code, now called UK Corporate Governance Code, introduced a set of best practice corporate governance initiatives into the UK. Again, it's the same thing that the SOX introduced rigorous set of rules which need to be followed, and the UK introduced a best practice code, so you can, implement them as per your requirements. And that's how the corporate governance code came into force, and now it's being followed. So we will be looking at the UK best practice ones more. So the OECD, which stands for Organization for Economic Cooperation and Development, has produced a set of six principles of corporate governance to guide policymakers when setting regulations for their own country. So what are these six OECD principles? They are basis of an effective corporate governance framework, rights and equitable treatment of shareholders and key ownership functions, institutional investors, stock markets, and other intermediaries, role of stakeholders, disclosure and transparency, responsibilities of the board. So the OECD principles revolve around these six things, which include, having a good corporate governance framework, which is effective. Then also the rights and treatment of shareholders is, equal, and there are uh, practices in place to protect them along the with the protection of these investors and other intermediaries. Then we have the role of stakeholders in corporate governance, disclosure, transparency, which we will be looking at later in this chapter. So this is particularly important for publicly traded companies because large amounts of money are invested in them, either by small shareholders, which is known as retail investors, or from pension schemes and other financial institutions. So for the case of Indian investments, you could, use mutual funds here. They invest a very large amount of money, and it is important for the corporate governance structure to be in place so that their investment is protected and it will not be misused, as we saw above, by the directors and management of Enron and Carillon. So there are both types of investors who invest, and each one needs to be protected. It's not the size of an investor that matters. So the code is further split into these five parts. So this chapter covers each one by one. And in this demo lecture, we will be looking at the first three ones. So as we saw that the code is more of a principles based code, it does not set out a rigid set of rules. It offers flexibility through the application of principles and comply or explain provisions and supporting guidance. So basically, you apply these principles and follow them and work around them. Otherwise, if you are not following these principles at all, you can at least, explain that why you're not following, and there is some flexibility here. Then we have board leadership and company purpose, the first one here. So, what is the board leadership and company purpose? So, a successful company will be led by an effective board whose role is to promote long-term sustainable success, thereby generating value for shareholders. This is an important point because it can be, used in a lot of context. So, a successful company will be one where the board is having a longer term view of sustainable success. So, what it means is that they are not focusing on short term gains only at the expense of long term gains. They want to grow, on a longer time frame and create value for shareholders. So, if you are, getting a lot of profits, but everything is just short term and you don't know whether this will last going into the future, then it's not really beneficial for the shareholders, as shareholders, are majorly interested in the longer term shareholding increase. And that's where the sustainable growth comes into the picture, where it is important to showcase that what you're doing for growth can be carried on for a longer duration, because slow and steady wins the race. It should be sustainable. The company should not run out of stamina even before finishing the race. So it's a marathon and not a sprint. Then we have the board establishes the company's purpose, values, and strategy. The director should lead by example and promote the desired culture. So basically, the people in the management, they are responsible for establishing and showcasing the company's purpose, values, and strategy. What this means is the purpose. For example, you could have purpose could be to create sustainable energy source for, let's say, electric vehicles and something like that. Values would be integrity, having working as a team, anything like that. And strategy would be the board's own strategy of doing things and how they would do it. Then the director set the culture itself at the first level, so that it trickles down and flows into the lower levels, and the company goes in that same direction. So it's very important for the board of directors to be strong and be influential enough in the right way to set the tone of the organization. So the board should ensure that necessary resources are in place for the company to meet its objectives. Board should establish a framework of effective controls to enable risk to be assessed and managed. So these are all self-explanatory points, that yes, there should be resources, there should be a framework of controls, there should be effective engagement with participation from shareholders and stakeholders. The board should ensure that workforce policies and practices are consistent with company's values. This workforce should be able to raise matters of concern. So basically, if an employee has an issue, he should feel like that once he raises that issue, he will not have to face consequences simply because he raised it. There should be an environment of trust and improvement where everything is taken in a constructive way for improvement and nothing is held personal. So there should be that freedom to raise the voice. Otherwise, if you suppress your employees and the workforce, then the company will not survive in the longer term. Everyone will, leave, and the company's labor turnover will be very high. Their resources will be spent on hiring new employees every few months. So that is something which needs to be taken care of. Then the main provisions of this principle, speaks about things such as how the risks are assessed so that the future success of the business is taken into consideration. Then the board should assess and monitor culture where behavior throughout the business is not consistent with the purpose, values, or strategy. The board should ensure management has taken corrective action. So basically, what this means is that if it is observed that the culture of the company is not being followed by everyone and everyone is trying to do stuff their own way, then it can lead to, the company's objectives not being fulfilled. They could derail the company's mission, and that's where the board's responsibility lies, that they have to take corrective action and ensure that everyone is working towards the same goal. Then, in order to formal, in addition to formal general meetings, the chair should seek regular engagement with major shareholders. The board as a whole should understand the views of the shareholders because they may have a few suggestions or they may have the ideology with which the management should pursue their decisions. So that will be of great insight, and ultimately, shareholder is the king, and so you have to listen to him and take his offerings into consideration as well. Then, when 20% or more of votes have been cast against the board recommendation for a resolution, the company should explain what actions it intends to take to understand the reasons behind the result. So, when a certain a resolution has been passed where there have been 20 or more votes against that decision, then the company should, explain why they are doing it, and more like convincing the other 20% people that what they're doing is good for the company. Because if more than 20% people are against it, then there is a chance that the directors are not following what the investors want. So again, the workforce should be able to raise concerns in confidence and anonymously whistleblowing. So whistleblowing basically means uh, raising issues and concerns anonymously. You could approach your HR department or the relevant authorities in your organization and report a fraud or any issue that you may have come across, and also request them to conceal your identity in case, let's say, the person you have raised the issue against, he may, come back at you personally from a threat point of view, and it could threaten your life or your family's life, anything like that. So there are arrangements in place to keep your identity concealed so that you can, comfortably raise any issues or concerns. Then the board should action to manage conflicts of interest. So, working for one client should not mean that your independence is compromised for another client. That is what conflicts of interest would mean in the context of this company. Then we have directors' concerns about the operation of the board or management of the company that cannot be resolved should be minuted. On resignation, a NED should provide a written statement to the chair for circulation to the board if they have any concerns. This is a simple point, nothing much here. Then we have board roles. The chair's roles is to lead the board of directors, flow of information and discussion, ensures satisfactory channels of communication with external auditors, ensures effective operation of board subcommittees. The chair should be independent to enhance effectiveness. So these are a few important points which you need to keep in mind to, understand the role of the chairperson. And he basically leads the board of directors He's responsible for the flow of information and discussion at board meetings, that first this needs to be discussed, then this needs to be discussed, and after the discussion, whatever information is arrived at, then how it needs to be distributed to relevant you know levels of the organization. Then we also have the independence of chair, which is quite important, as he should be someone separate from the board of management itself. Like he can be the chairperson of the board, but him having any other responsibilities will, lead to conflict of interest, and he could act in the best interest of his own decisions. Then the chief executive role, the one who comes after the chair, is that he ensures the effective operation of the company, head of executive directors. So ideally, the chair and CEO should be separate. The executive directors have the responsibility for running the company on a day-to-day basis. So now we will come across two types of directors, which is the executive director and the non-executive director. So the executive director has the responsibility to run the operations of the company. They are the ones responsible for the progress of the company. Then we have the non-executive directors, who are basically, let's say, supervisors of the executive directors. If I was to, put it in a very simple way, supervisors. So they keep the executive directors in check, so that the executive directors don't take decisions which are not in the best interests of the shareholders and other stakeholders. These entities ensure that the objective of the company as a whole is being met, and also that you know appropriate controls and other things are in place to ensure that no executive director is in a position to take advantage of the company. Then what does the NED mean here? Let's understand it from here once. They monitor the executive directors and contribute to the overall strategy and direction of the organization. They are usually employed on a part-time basis, as they are not full-time employees and they are not the ones responsible for the day-to-day operations. They do not take part in the routine executive management of the company. What will NEDs really do? They will participate at board meetings, bring experience, insight, and contacts to assist the board, sit on subcommittees as independent knowledgeable parties. So this is basically a board which is separate from the board of directors. They are basically there to supervise and monitor them. Then what is the advantage of this activity? So oversight of the whole board. This will keep the board of directors in check. And as the NEDs will be independent, they act as a corporate conscience. So if there is a supervisor already appointed, then there is no as such opportunity for the person to take take decisions in their own interests. Basically, if you're giving an exam and you know that there is a supervisor who's really strict and is very experienced, then you will be discouraged to even try to cheat itself. You may not be a cheater in the first place, but there is a chance that a good supervisor will eliminate your motivation or even the need to cheat. So this is what the NED does. It basically acts as a barrier to fraud and in ill-informed decisions being taken. And they also bring external expertise to the company, as these NEDs will be really experienced and having been there in the industry for a lot of years. Then, but of course, there are a few disadvantages as well. It can be difficult to find the right NED, who have the relevant skills and experience required by the company. So, for example, the NED you have appointed is someone who has worked in the automobile industry, the cars industry, and you are someone who is running a company of fast moving consumer goods, FMCG, let's say anything like that, soap, shampoo, anything that like that. So, the NED's experience, even though he may have 30 years of it, it's not that relevant to your company's goal because you are in a separate industry itself. So at that time, he may be the only NED that was available, and that's why you have gone for him. So that's a disadvantage. So the fees these NEDs charge can be quite expensive because they are experienced and they are taking time out for working part time. And because of that same part time reason, it is quite possible that they are not fully aware or they fully take the initiative to understand the company itself, and certain issues can go unnoticed. And this point is there. This basically means that there will be a network or a group of people who just hire NEDs from that group itself, and there is no such logic for their appointment, and they are just hired to for their they are hired by their friends or families to increase the pay the family earns as a whole or anything like that. It can become a partial activity instead of doing something good for the company. Then we have division of responsibilities. Basically, the principles about this say that the chair leads the board, responsible for effectiveness, should ensure effective contribution of all board members. He should ensure that directors receive clear, accurate, and timely information. There is no use of inaccurate and untimely information. It should be both accurate and timely. Board should be balanced so that no individual or small group of individuals can dominate board decisions. So this point is basically the entire the crux of corporate governance, where it is to ensure that no individual or small group of individuals can influence the entire company. They should not be in a powerful and dominant position. Everyone should have, equal or close to equal power. Then the chair also should ensure that NEDs have sufficient time to meet their board responsibilities and should hold management to account. This basically means that NEDs should be able to, devote time to the company and call out certain things and issues if anything is done by management, because that is what they are there for. Then we also have, so basically the main provisions of this one is that the chair should be independent. Chair and CEO roles should not be taken by the same person. The CEO should not become the chair of the same company. So this is where the Satyam scam comes into the picture. If you are interested enough, you can look into this on your own time. This is where the CEO and chair of Satyam was the same person. So he had undue influence and power to manipulate the financial statements and defraud the company. It was a very big scam in the Indian context. And this is where the Indian corporate governance really took charge from after this incident. And yeah, you can give it a good read or watch a video related to it. It will be interesting for you. Then we have at least half the board, excluding the chair, should be independent NEDs. So basically, the board should comprise, let's say, of odd numbers 11, of which one member will be the chair. He is the chair. Then the rest 10 should be comprised of 5 and 5, where 5 are the executive directors and the other 5 are non-executive directors. So this is how the structure should look like. You should keep it in mind that excluding the chair, the half the board should be of independent NEDs. This will ensure that there is not much power with the executive directors to be dominant and make bad decisions. The board should identify the independent NEDs in the annual report. So they publish the annual report yearly and the NEDs should be identified in them. Independence would be deemed to be affected if a director. So if the director has, lost his independence with regards to the company and being a NED there, then this is how he could lose his independence. If he has been an employee within the last 5 years, he has had a material relation, business relation with the company in the last 3 years. So I can write 5, 3. The business relation could be, as a partner, shareholder, director, or senior employee of a body that has been in such a relationship. This basically means that if he has had any business relationship with the company in the past 3 years, and whether he has been employed in the company in the last 5 years, then if he has received any remuneration from the company in addition to a director's fee, participates in the company's share option or a performance related pay scheme, or is a member of the company's pension scheme. So basically, for an NED, the only source of income allowed should be the fees. Anything else which is related to the share option, pension schemes, or anything like that is not allowed for an NED director. And if a director receives that, he will no longer be independent. Then, if he has close family ties with any of the company's advisors, directors, or senior employees, then his independence will be affected. Then, if he has cross directorships or has significant links with other directors through involvement in other companies or bodies. So, what this basically means is that I'll be a NED in your company and you be a NED in my company. So, that will affect their independence as it's a cross director relationship, and none of us would like to raise any concerns as it would affect our own companies in similar manner. So it's like I'll stay quiet, you stay quiet. Then the NED cannot be a significant shareholder as well, and he cannot serve the board for more than 9 years from the date of their first appointment. So the NED should be replaced after 9 years. So you can remember these three important timelines: 5, 3, and 9. 5 for employee, 3 for business relationship, and 9 for being NED. So basically, as everyone has a chair, the NED should also appoint one of their own NEDs to be appointed as a senior NED, for example, so that there is a proper balance of the EDs and NEDs. Then we have the NED and the senior independent director should meet without the chair present at least annually to appraise the chair's of performance. So even for the chair's performance, these NEDs will be responsible to assess it. Then these NEDs appoint and remove EDs and scrutinize performance against agreed performance objectives. So the NEDs are responsible for, assessing the ED's performances throughout the year. Then the responsibility of chair, CEO, senior independent director, board and committee should be set out in writing and publicly available so that there is transparency for understanding who is responsible for what. Then we have the annual report, which sets out the number of meetings of the board and its committees and the attendance of each director. New appointments to board should be taken into account other demands on the director's time. So, for example, if you are a full-time executive director in one of the FTSE 100 companies, so this is basically Financial Times Stock Exchange 100 company. In India, we have the Nifty 50 or other significant appointment, then you should not take more than one NED. And these appointments should not be made without prior approval of the board. So that was our one point done. 2 points done. This is basically the third and the final one now. Composition, succession, and evaluation. So composition basically means how the board is composed of. Succession means that going into the future, how one after the other people will be appointed. And evaluation is basically the performance evaluation and how it should be evaluated. So the principles include the appointment should be subject to a formal, rigorous, and transparent procedure. So, it should not just be like, okay, I know my friend, I'll just appoint him. No, it should not be like that. There should be interviews and everything like that for everyone. Then an effective succession plan should be maintained for board and senior management so that there should be a person already, ready to move up the rank after one of the current board members leaves, resigns, or, retires, anything like that. Then we have appointments and succession should be based on merit and objective criteria and should promote diversity. So again, it should be fair, not partial, and it should be, proper performance measures. So the appointment should be, based on merit, performance, and should promote diversity. It should not be like it's only for men. There should be the one who deserves it the most. Then, yeah, it's the same basic points itself. The main provisions say that a nomination committee should be established. So there should be a nomination committee which, looks at all these things to see who should come after the existing member. Then we have majority of the committee members should be independent NEDs. So for the nomination committee, majority should be NEDs. The chair cannot be a member of the committee when the committee is dealing with the appointment of their successor. So basically, when it comes to replacing the chairperson cannot be on that nomination committee at that time. But yeah, generally he can be when it comes to other directors. So this is a, you know, a rule which can be remembered and asked in the exam by twisting it somewhere. Then we have the director should be subject to annual re-election. Chair should not remain in the post again 9 years, same as NEDs from the date of the first appointment, can be extended for a limited period of time to facilitate effective succession planning. So it can be extended for a temporary time until the next person is, in the office and has taken charge. So yeah, then apart from that, it's the same thing that external search consultancy should be used. There should be formal and rigorous annual evaluation of the performance. Then having external evaluators if the company is, FTSE 350 or anything like that to, give a unbiased performance evaluation of the company itself. The annual report should describe the work of the nomination committee, including the process used in making appointments, how the board evaluation has been conducted. And yeah, basically it's just that it's not that important. Then we have the role of the nomination committee is to basically decide on appointments of board directors and senior management. This is to ensure best person for the job is secured. It's basically nomination committee is basically the HR department of the board management, Nomination committee is HR for the senior level managers. Majority of this should be independent entities. Advantage is that it reduces jobs for the boys. Executive directors might appoint other directors with whom they are friends or used to work with but do not have the skills required. So what this will eliminate is, let's say, if an executive director himself is responsible for, you know, recruiting top level management, then there is a chance that he will offer those positions to his friends, and that will, you know, the company will not then get the best resources, as there could be someone who is better suitable for that job, but just because the board of management already has a friend, he has, put himself into that position. Then we have reduces the risk of improperly affecting board decisions. If executives might appoint people to the board they know will vote in favor of the same decisions as them and therefore can influence board decisions which may not be in the best interests of the company. So these 2 points are quite important. So basically, what is the advantage of nomination committee? This will ensure that people don't hire their own friends for the top level management. And the second advantage being that, let's say, if you are a part of the board of management and you know someone who owes you favors and always listens to you because you are, a senior person, then there is a chance that you could employ that person uh, on the board of management, and you'll know that whatever you vote for, that person will also vote for the same thing. So that will increase the majority of vote, but that same decision may not be in the best interest of the company, and it may be a good decision for you personally. So having a nomination committee will eliminate that thing as well, so that you will not be able to, involve a person who can be influenced by you. So it will ensure that the board of directors are independent individually. And yeah, basically it's to avoid any ethical concerns and always act in the best interests of shareholders is what the key and summary point of this is. That there are measures taken to ensure that directors don't abuse their power, and it's for the shareholders. So we are done until half of this chapter, and this marks an end to the demo series of audit and assurance. We have covered 2.5 chapters. Again, this chapter and this exam is not that lengthy because the portion is quite small, but the exam is quite different as it has 70 marks of subjective questions. And that's where my role is more important to you as a mentor, because you can study the study text even on your own, but having, you know, experienced person having reviewing your mocks and anything else, clearing your doubts, clearing your exam kit doubts, that is where you will gain confidence and know that yes, I can actually pass this exam comfortably, and also stand a chance to score high enough to maybe secure a rank or anything like that. It's basically just a confidence game. It is, I'm here to boost your confidence. And yeah, that's it. Feel free to reach out to me if you have any queries you need to be resolve or anything like that. And yeah, I'm looking forward to, cover the rest of the portion and guide you through the excellence. With Marg, you are on the right path to ACC excellence. Hope to see you soon. Thank you.